Yeah. Okay, cool. So I might ask you. So right out of the gate, Brenton. Oh, I'm so sorry. Um, in the title of this video, I spelled your name wrong. I'll correct that.
Oh, all good.
Brenton with a T-E-N,
Correct.
CPA,
No, not a CPA.
not a CPA. What do you do,
No.
Brenton?
I specialize in tax incentives for real estate investors, small businesses that own the real estate, or people that are in the business of investing in real estate, such as syndicate firms.
Even better than a CPA. You
Yeah,
actually get stuff done.
I,
I'm just kidding. CPAs
I,
get stuff done. I'm sorry. Sorry,
but
CPAs.
no, on the CPA or enrolled agents or just accountants, because not every accountant is a CPA. I work hand in hand with the CPAs and the client because while these tax incentives are extremely beneficial for the right tax situations, I don't know the ins and outs of each individual investors or owners' tax situation. So I need to lean on them, but also as much as we'd like to think that our accountants know all tens and thousands of pages of the tax code, that's just simply impossible because it's so in depth, but also it's continuously changing. Um, Specializing in these niche parts of the tax code, I can be an ally to them because if I had no work to their plate, bring audit protected, IRS approved, parts of the tax code to the table in which their clients can save a lot of money. Um, I am, a tool in their toolkit. And
So
then,
so let's dive right into it. So
yeah,
the so 27, so big beautiful bill, can I, if I'm a landlord, can I write off all 27 and a half years of depreciation in year one?
no,
No.
no.
I heard somebody
Um,
I heard somebody say that. So what can we do? What has changed recently?
so one of the biggest misconceptions out there is people will throw around the phrases cost segregation and bonus or accelerated depreciation as if they are the same thing. They're completely different things.
Interesting.
Um,
Can
when
you
you
define
own,
both?
yes, first, just like a basic accounting principle. When you own an investment property or you're a business that owns its real estate, one of the things that you have to do is to depreciate that asset. The tax code says that it's going to lose some of its value on an annual basis.
Right?
It's not something you get to do, it's something you have to do to be in compliance.
You have to do it. It's
Yes.
not like, oh, I want to depreciate my residential rental home over 27 and a half years because I save. It's not even an option. You're required to do it.
Yes, to be in compliance with the tax code. And there are
Interesting.
two ways to depreciate your property according to the tax code. The first, kind of what I call the default method, is straight line depreciation.
Okay, that's the
Um,
27 and a half years I'm talking about. Just like one
Sometimes
sometimes.
27 and a half or 39 years.
Okay,
The only asset class that depreciates over 27 and a half is long-term residential.
got it.
So as long as the leases are greater than 3 months on average, we depreciate that over 27 and a half.
Interesting.
Is a short-term residential like your Airbnbs or any other asset class, office, industrial, um, it depreciates over 39 years.
Wow. So
So
alert everybody that thinks you're doing your turbo taxes right. You have an Airbnb and you're doing it on a 27 and a half year schedule. You are doing it wrong
correct.
and you need to
Yes.
change to be in compliance.
Yes. Oftentimes when I work with clients, we have to correct those mistakes. And look, accountants are my best friends in the world. I want to add another tool to their toolkit. But many accountants are just a little green when it comes to this stuff. The tax code is very in depth and very complicated. And it's the common error that we see, but it's not that big a deal. But it is one that, should be corrected to be in compliance.
Okay.
So back to straight line. So depending on what asset class and, length of rental we have, you buy a building. One of the basic accounting principles is buildings depreciate, but land does not. So unless it is a condo unit in which it literally owns nothing outside of the walls, we have to make some allocation to land value on the purchase price.
Understood.
Now, if you're different parts of the country have different land values. And my best examples are if you have a property in like LA County,
Yeah.
land is 30, 40, 50%. It is what it is.
Makes
We
sense.
look at independent third-party appraisals. We look
Yep.
at tax assessors. It is what it is. Other parts of the country, 10, 15, 25%. So we have to dock off whatever that percentage is. The remaining amount of your purchase price is what we call the depreciable basis. And if
Yeah.
we're using straight line depreciation, we just divide that by 27.5 or 39. And it's called straight line because we take a straight line or an even amount every single year. The alternative method is cost segregation, where we say, well, hey, wait a minute, this single family home is made up of a lot of different components, some of which are going to last hopefully 50 or 100 years, and some of which, carpeting will be lucky if it lasts, 7, 10. So what it does is we segregate or itemize every single component of the property into different length class lives. And the tax code has what I like to call more logical class lives based on how long things last. So when we do cost segregation, in addition to the 27.5 or the 39 year, we now enter 5, 7, and 15-year categories into play.
I'm going to pause you right there. You said in addition to. So are these they're not in lieu of, they're in addition to?
Correct. Some property will stay in the 27.5 or 39-year category, whether you use straight line or cost segregation, because that's just each category has a definition of what types of property fall into those class lives. Things like door frames, the pad, beams, those will always be 27.5 or 39-year property.
So when you said in addition to, I started thinking like, oh, good, great. I get to take the whole non-land value and straight line it. And in addition to that, I can also cost segregate other things and accelerate those.
No, we're just segregating that depreciable basis.
That's in lieu of.
In lieu of, yes.
Okay.
Correct. What I meant by in addition to, we're adding new class length categories that we can now reclassify property into. So just a few quick examples. 5-year property. If we run with the residential example, think like plank flooring, carpeting, countertops, cabinets, some components of like other components of kitchens and bathrooms.
Okay.
7-year property. If you have furnished places, furniture will fall into there. Some lighting fixtures. Quite honestly, though, 7-year property doesn't pertain as much to residential. So there's oftentimes not much property that falls into that category. 15-year property is what we call land improvements. So think like specialized landscaping, decks, an in-ground pool, fencing, sidewalks, driveways, parking lots for like more commercial type properties. We love parking lots. That's 15-year property. And when it comes to cost segregation, we do not like parking garages because those are structural. So those stay in 39-year. And the reason I say that is the 5, the 7, and the 15-year property are what's known as bonus eligible categories. So any property that's placed into those categories becomes bonus eligible. And that's where the interchangeable terms that people use incorrectly of cost segregation and bonus depreciation, they're different concepts. Cost segregation is just the itemization or the segregation of the property into the 5, 7, 15, and then the remaining stays into the 39 year.
It's the act or the framework of doing it that way.
That's all cost segregation is. Done. Period.
But the 7, the 5, 7, and 15-year property are the bonus depreciation classes within that methodology.
Yes, eligible classes.
Eligible classes.
Yeah, I want to stress the word eligible because 2017, the Tax Cuts and Jobs Act created the ability to apply bonus or accelerated depreciation to cost segregation. What does that mean? It means, depending on what year, the original Tax Cuts and Jobs Act was 100% bonus eligibility for a certain period of time from introduction in 17 through the end of 22. But then bonus eligibility started to sunset, 80% in 23, 60% in 24. And actually, for the first 20 days of this calendar year, 2025, it's 40% bonus eligible. The big, beautiful bill did not kick in until January 20th. So what does that mean? Based on when the property was placed into rental service, the first time that it was eligible for rent, not necessarily the first day that a person walked in and paid rent, the first day that it was listed on apartments.com or Airbnb or, LoopNet for sake of a commercial property, is the bonus eligibility date.
Okay.
So let's run with an example here in 2025, past January 20th. A property was placed into rental service. It is 100% bonus eligible. We did a cost segregation study on it. So all of the 5, the 7, and the 15-year property is eligible to be bonused by as much as 100% into 2025. Now,
what is 100% into 2025? What do those words mean?
So instead of taking the 5, the 7, and the 15-year property, which now, instead of being spread out over 27 and a half years, the 5-year property is spread out over 5,
Got it.
7, and 15.
But instead of those time frames, we can, if we want, take all of the 5-year property and put it into year 1. So we're just front loading that depreciation. About the 7 and the 15.
We can do the 7 and the 15 too. They're 100% bonus eligible.
But once you depreciate them, accelerate that in the first year, you're done. You can't come back to that well. Is that right?
Correct. But if you bring your income down to 0 and there's still depreciation left over, it carries forward. It's not a use it or lose it. And for sake of example purposes, when we're thinking about residential properties, 15 to 40% of the depreciable basis will be placed into bonus eligible categories, meaning 60 to 85% of it will still be spread out over the 27 and a half year.
Understood.
So we're not bonusing everything. We're not completely using up depreciation, but you said a comment early that you can bonus 100% of the 27 and a half year. No chance.
Okay,
not in the residential asset class.
All right, let me zoom out for a second and break this down. This is very fascinating. So, and just to try to draw the application, the practical application for your mom and pop landlord, which is like 97% of people who own residential real estate in the United States are mom and pop, non-large multifamily mom and pop investors. And they, on average, own 1 to 5 rentals. So practically speaking, if I'm only going to be able to be bonus depreciation eligible for, let's say 20%, let's say my properties, I'm going to use numbers. Let's say my property on the market, fair market value, 500,000. I'm in Phoenix. Someone gives me expert advice that the land is worth 20% of that. So now I've got 400,000 left over. Of that 400,000, if 100,000 can be sort of segmented into 5, 7, or 15 year bonus depreciation categories by doing a cost segregation analysis, that's 100 grand. The other 300 grand I've still got on the 27 and a half year schedule, assuming I have average lease length of 3 months or longer. Am I correct so far?
Yes.
Okay, so of the remaining 100 grand, the big beautiful bill might say, hey, this 100 grand, you can take all of that against your income this year in year 1. Now, if this is like a pass-through roll-up, like I've got it in an LLC, but it just rolls up to me as a person or whatever, then I'm not taking this loss or this depreciation against like the LLC entity or a business unless I've got like a corporation. This actually affects my personal income tax obligations. Yes?
Possibly. That's where it boils down to the individual owner's tax situation. Now, with 100% certainty, you can always take the depreciation benefits and offset real estate related income. Where it kind of gets into the weeds and where I really harp on being a seat at the table with the accountant, perhaps the financial advisor.
Because they have the
is
liability and the audit liability, right? You're just an advisor.
Correct. But most people have two main types of income. They have their active income, which for most Americans is W-2 income from whatever income, whatever their occupation is. But then they also have passive income, which for most people, there's a distinct line in the sand between those two types of income, and depreciation benefits from what oftentimes is passive real estate cannot offset your active income from a typical 9-to-5 W-2 job.
Could it affect like owner draws from a business you own? Is that in the right category?
Perhaps if the business owns its real estate and it's, kind of something where the business is paying rent to an LLC that, is covering the mortgage, the taxes, the insurance. But
I'm not following that. What did you just say?
Oftentimes when businesses own their own real estate, they hold the real estate in an LLC. The business pays rent to the LLC, which oftentimes covers the mortgage, the taxes, the insurance. One of the other items on these LLC's profit and loss statement is depreciation. So when they're paying rent to this entity, one of the benefits of depreciation is that they can pay a little bit extra because the depreciation, wipes out that income. Hence, it creates the ability to, pay more than the mortgage, the taxes, the insurance. And one of the potential benefits of creating a tax deferral through cost segregation is we can increase that depreciation amount this year, and oftentimes for subsequent years, because we're not going to use up that entire amount just with rent.
Okay.
So essentially what the business can do is pay a little bit higher rent, and the depreciation tax deferral from cost segregation, the incremental depreciation from straight line depreciation can wipe that profit out, and the business owner can essentially pay more rent. Paying more rent reduces their taxable business income, but they're paying it to an LLC that they also own. And we, prior to cost segregation, would have been creating a profit in this LLC, but the tax deferral wiped that out. So they've essentially created a loop of paying themselves money but having no tax liability on it.
Okay, that sounds really smart. I would think that IRS auditors are gonna at some point pump the brakes and be like, no, you're paying way above market rent.
It still needs to be market rent. There needs to be a lease agreement. It still needs to be market rent. You can't come up with some asinine number.
Okay.
So the math on the equation has to work.
Okay, so let me back up a little bit. Generally bonus depreciation does not offset ordinary income. Did I use the right word? Ordinary income?
Correct. Unless and it can still be W-2 income, unless that W-2 income is real estate related, or
so
if they
like me.
qualify as a real estate professional.
So that's me. I qualify as a real estate professional. I have a license. I have a real estate property management company. I make my living in real estate. So now I get to benefit from bonus depreciation where most people don't.
Correct. If you qualify as a real estate professional, the line in the sand between your passive and active income buckets does not exist. So you can take the depreciation benefits and offset all of your income. Whereas your doctor, your lawyer, your banker, they can't take depreciation benefits and offset that type of income.
They can only offset the income that real estate is, their entire real estate portfolio is creating for them.
Correct. And I say oftentimes in a vacuum, a single property will likely not produce enough income to warrant the tax deferral. But if you start talking about a portfolio, 2 properties, 5 properties, if they're set up in the right way, oftentimes what you can do is, oh, now I've got properties that are kicking off a little bit more income. Now, again, in a vacuum, cost segregation may not make sense for a single property, but now you've got a scenario where, oh, well, I could do cost segregation on the two properties with the highest basis, the highest appreciable basis, and offset the income for the entire portfolio.
On those bonus categories, Brenton, I'm assuming every 5, 7, or 15 years, I get to re-up those. Like I get to keep churning that 5 years over and over, right? Every 5 years from now, clock resets when I'm doing cost segregation analysis, right? I keep rolling with that.
If you replace those items, yes. You'd have to add in new items. So one of the things about, and that's a great point that you brought up. The depreciation of a property is not simply based on that first time that you purchase it. When you do renovations and improvements, you remove things, you add things in. The depreciation schedule it's like a living animal. You got to remove items that you take out, and you got to add in items that you put in. The cool thing about the items that you remove is if they still have any depreciable basis, you get to write off the value of those. And then when you put in new items, you can't just expense everything. There's rules within the tax code about what you're allowed to expense and what you have to capitalize.
When I do a kitchen remodel, heaven forbid I expense the whole thing, get audited, and the IRS is like, what are you thinking, man? You can't do that.
So the tangible property regulations, which were introduced in 2013, are essentially rules behind when you do renovations and improvements to a tangible asset like real estate, what you're allowed to expense and what you have to depreciate or capitalize, which is capitalize is the fancy accounting term for having to depreciate something. To be in compliance, you are supposed to follow those rules. Now, if you own a couple of properties and you're the mom and pop, like you were explaining, which makes up the vast majority of real estate investors, is the IRS going to come knocking on your door? No. But
you still want to follow the rules.
You still want to follow the rules. And I will tell you, being in compliance with the tangible property regulations, this is going to sound backwards, but you're just going to have to trust me. Being in compliance with them is very, very tax advantageous. A lot of accountants, and again, accountants are my best friends, will simply prescribe to what's known as the de minimis safe harbor rule. So depending on the value of the property, they'll set a de minimis safe harbor amount. Call it $2,500, $5,000, $10,000, depending on the scope of the property. And if any repair or maintenance or improvement is less than that amount, they will expense it. And if it's more than that amount, they will depreciate it. Pretty simple system. And quite honestly, for the most part, it oftentimes is quick and easy. But the tangible property regulations are just filled with tons of examples. And there are instances where a $50,000 roof membrane could be expensed. But if the accountant's using that de minimis safe harbor rule,
I see,
they're going to capitalize it. Now, if you're putting a $50,000 roof membrane in, you've got to pay the roofer $50,000. And if you unknowingly, mistakenly capitalize that or depreciate it over 15 years,
yep,
the roofer's not going to take a 15-year payment plan. So you always want to expense as much as possible so that you can match, the check that you had to write the roofer, and the ability to depreciate or expense that.
What's the 2013 thing called again?
The tangible property regulations.
So Brenton, I have a question for you. Because I know how my brain shifted when I started doing, I became expert about something, and then I started seeing the world differently. I think I know the answer to this already. When you walk through real estate, are you looking at 5-year, 7-year, and 15-year property?
Personally?
Do you notice that when you're out and about, like at a restaurant?
Personally, no. But what I will say is one of the first questions I often get when I talk to new prospects or clients is my property, is this property, my current one or this one that I'm looking to buy, is it a good cost segregation candidate? Or is it a good candidate if I do a bunch of renovations and improvements? And I say, that's not the right question. The first right question is my tax situation, can it take advantage of cost segregation or some of these parts of the tangible property regulations?
Got it.
But also, is this a long-term real estate investment? If you are looking to flip, unfortunately, the tax code cost segregation is a bad idea. And the reason for that is what's known as recapture. So when you go to sell the property and you utilize cost segregation, you created this big tax deferral. The IRS says, well, hey, wait a minute. You only had to pay, X in taxes because you used cost segregation. If you had used straight line depreciation, you would have paid, X plus $50,000 in taxes.
Right.
When you go to sell the property, you use a completely legal means of depreciating your property, but there's catch. The IRS recaptures the difference in those taxes. Now, early on, when you create that tax deferral, the delta between those two numbers is very big. But as the 5-year property burns off, the 7-year property burns off, it gets smaller and smaller and smaller. Early on, that recapture is significant and you will lose more than you gained. But as the property burns up,
how could the recapture be more than what you gained?
Well, it also comes down to how you spent those tax savings, because one of the other things is, instead of, it's not like the IRS is cutting you a check. You're just not sending them, whatever, $50,000 in taxes because you wiped
so now they're going to hit me with penalties and interest?
No, but they will recapture the difference in those taxes. And early on, when that delta is very big, that can really sting. Now, it also comes down to, did you cost segregate a property where we segregated 20% of the property or 50% of the property? But also, let's say you sold it after 2 years. Did you use up that entire tax deferral? So like if you and I owned a property together and you're a real estate professional, so you used up the entire tax deferral in year 1. Yep. Whereas let's pretend I'm not a real estate professional. I chipped away at it and we sold the property 2 years later. Your recapture is going to be a lot different than my recapture. So it depends on how much of it you use, but also how significant of the tax deferral. But then the other thing is, so we talked about bonus eligibility. I was really hitting on the eligibility component.
Yeah.
Just because a property is 100% bonus eligible based on when you placed it into rental service doesn't mean you have to do it. You don't have to bonus the 5, the 7, and the 15 year. But then the other thing is, you could bonus the 7 and the 15 year by 100%, but then spread the 5 year out.
Okay.
Or do 50% bonus on the 5 year.
You can go anywhere from the minimum. You can go, if it's a 5-year property, you could do anywhere between 20% to 100% year 1. You choose. That's what I'm hearing you say.
0 to 100%. Yeah. And then whatever, if you picked a number that wasn't 0 or 100, the remaining, so let's say you bonused 50% of the 5 year.
In the first year.
The remaining 50% would get spread out over years 2 through 5.
Oh, okay. So you can't do 50% year 1, 50% year 2. Whatever you choose to take in the first year to maximize your scenario, then everything else is over the remaining period.
And oftentimes, so the 7 and the 15 year categories are much more spread out. So 99 times out of 100, clients will take full advantage of the bonus for those years. But the 5-year property is interesting because it's obviously a much shorter category. Within residential, it's oftentimes where the majority of the bonus eligible property gets placed. But based on your tax situation, some people like to play with how the benefit of the 5-year gets implemented. So one of the things that I mentioned earlier, I like to be a seat at the table with the accountant, the financial advisor. The tax code's tens of thousands of pages long.
Yep.
Less than 100 of them talk about paying your taxes. The rest talks about ways to deduct and defer paying your taxes.
Yeah, for sure.
Work smarter, not harder. But oftentimes people that own real estate have complex tax situations. And we're just talking about two little niche parts of the tax code. So when implementing this, it's critical to know the whole picture. And I don't know the whole picture. I just know these two parts of the tax code, cost segregation and the tangible property regulations, really well. So it's important that these fit into the overall tax
strategy.
So the way that it gets implemented is not cookie cutter. Your tax situation is
makes
different
sense.
than mine.
Well,
but then the other thing is, so sorry to just cut you off, but
no, you're fine.
as a real estate professional or a business owner, not paying taxes sounds really cool, right? But
it sounds amazing.
Yeah, it sounds amazing. But
as long as it's legal.
Yes, and it is. But let's pretend you did cost segregation and you completely wiped out your tax liability, and then you went to go buy a home and you couldn't get a mortgage because you have no paper income, or you're a business owner and you look to go get a line of credit and you have no income on paper. So it's critical that these strategies are really powerful.
Yeah, look at the whole picture.
Legal,
make sure you can prove up income for your ability to borrow for other important things coming up. That's an important piece. Okay, well, let me get to this. Let me ask you this question, Brenton, because this all sounds very intriguing, especially for someone. So there's two questions that pop up. One, sounds like every landlord should go out and get their real estate license so they could qualify as a real estate professional. But you're going to tell me that's not going to fly, Mark, because you actually have to earn part of your or most of your income from real estate. Is that right?
Yes. The two biggest criteria to qualify as a real estate professional, the first is pretty low hanging fruit, 750 hours in real estate related activities, whether it be property management, landlord, real estate agent, contractor, interior designer. It's not just residential real estate agent.
Renter, just kidding.
So there's dozens of ways to get those hours. The hardest one is greater than 50% of your time has to be spent on real estate related activities versus non-real estate related activities.
And that's
so all of a sudden, any 9 to 5 doctor, lawyer, banker are my big 3 examples. There's no way. There's not enough hours in the day.
You can't just be surfing Zillow every night for 5 hours and have that count?
No. The IRS is a very big stickler about this, and the biggest reason was married individuals where there was, one breadwinner. The non-breadwinner would go get their real estate license, go rent a condo, or go sell a house. Say, I'm a real estate professional. They'd invest in real estate. Married filing jointly, go right off all their income. Shockingly, the IRS didn't like that. So they're very big sticklers about that qualification.
Okay, so next question, like to try to bring this down to like applicable to my 450 clients. I'm going to selfishly ask you,
yeah, please.
Well, I'm just going to ask you this. The conclusion in my mind is, unless you have a very low debt, unless you're very low leveraged on your residential real estate, if you're not a qualified real estate professional, cost segregation probably doesn't pencil most of the time.
Not in a vacuum for an individual property. When you start to talk about it may though. I mean, for example, you mentioned, Arizona, super high luxury single family homes that are either being short-term or long-term rented. I know homes that are grossing $500,000, $600,000, $700,000 a year.
Okay.
That could make sense to do cost segregation. But then the other scenario is where you have a portfolio and, hey, it's kicking off modest income, but you don't need to do cost segregation on all of them. You could do it on, like I said, the 1 or 2 with the highest depreciable basis because it's more bang for your buck. And it could wipe out the tax liability for all 4 or 5.
Brenton, what if I put together a limited partnership 20 clients are like, hey, Mark, I'll throw in 100 grand. We go out to Alabama because you can buy a $300,000 home that's renting for $2,400 a month. And that's a great ROI, right? So I go prop up a property management company in Birmingham, and I put together a limited partnership. We find someone willing to lend my money, and we lever this like 60%. So we got 40% equity, 60% debt. Can I, as the general partner, as the syndicator, take all the bonus depreciation to me, and then still like sort of in my partnership agreement with the rest of the people that don't qualify as real estate professionals, like somehow like can I take the primary benefit to offset like all of my income, and is that an advantage to me, and thereby like on the back end kind of like give them lower management fees or something like that?
Yeah, and I help clients set that up all the time. A lot of real estate syndicators do that because the investors that will likely have no active involvement and have your W-2 jobs that cannot benefit from the depreciation benefits would essentially be wasting the depreciation losses. So oftentimes what real estate syndicators, general partners in those situations, or managing members in LLCs will write their operating agreement to say that the depreciation benefits will flow non-pro rata. There's no laws against if you have 20% equity that you can't get 85% of the depreciation benefits. There's nothing, as long as the operating agreement stipulates that, you can do that. And that's oftentimes what those professionally managed syndicate firms will do. But also I have, moms and pops that will, dad and son will go 50-50 on a real estate investment. The son is the active real estate professional, and they will write their operating agreement to say that the depreciation benefits are going to flow 80-20. Now, it wouldn't make sense to take 100% because we still want to make sure that the passive investor has no tax liability. So give them enough depreciation benefits to wipe out their tax liability, but don't waste the extra amount and have them flow non-pro rata. A lot of people get caught in the mindset that, everything has to be pro rata, but, oftentimes the general partner in those syndicate deals will put in 10% of the money, but get 20% of the deal.
Yeah.
So a perfect example of a non-pro rata allocation already. That is
pretty common.
Very it's kind of like, a light bulb moment, like duh.
So in other words, if I was doing some limited partnership syndications, it's probably the most obvious, quickest path for me to pay zero income tax.
Yes, and it also gives real estate professionals like that the ability to leverage up their deals, obviously, because they're bringing in outside capital, but also leverage up their tax benefits through cost segregation and the tangible property regulations. And then the other cool thing is that I mentioned, because of recapture, these benefits only benefit long-term holds. But I have a lot of people that do and are very successful with flips. And the unfortunate reality with those is you get the one-time payout and capital gains. Capital gains are obviously not fun, but if you have what I like to call coupon clippers or mailbox money with your long-term rentals that come with the tax benefits.
I don't know what you're talking about right now. What's a coupon flip or what's mailbox money?
If you have a long-term rental and you get your monthly rent, I like to call it mailbox money or coupon clipper. Once a month you go to the mailbox, you get your check. So it's consistent income.
Yeah.
Whereas with flips, it's the one-time payout in 12, 18, 24 months. I don't know. And it comes with capital gains. But the great thing about long-term rentals, along with what hopefully is consistent monthly income, is the tax benefits. And again, in a vacuum, the tax benefits may not be warranted for a single property, but the other way that you can use that tax deferral is to offset capital gains.
There's I'm going to pivot real quick in the last few minutes we have here. There's something called, obviously most people have heard of 1031 exchange, where they sell a property, and instead of paying capital gains, they reinvest the equity into something of equal or greater value. There's certain time frames and stipulations. We've done several of those for clients over the years as they expand their portfolio. It's a really great idea. There's something else that I'm not remembering the number, or it's another type of exchange where people can just simply contribute their property for shares in like a REIT.
Yes, I'm not as familiar with that one as I am with the 1031. One thing I will say about the 1031, because it sounds like you've covered that a few times, is if you 1031 your property into another property, and I want to use simple numbers here. Let's say you sell $1 million property via 1031 to purchase a $2 million property.
Okay.
And then you call me up and say, I want to do a cost segregation study, or I want to vet a cost segregation study on my new $2 million property. The depreciable basis that we get to start from before we deduct off land is not $2 million. It's $1 million. We can't double dip on tax incentives from the code. You've rolled $1 million via 1031 into this new property. That is not eligible property to cost segregate. We only get to do the $2 million or the $1 million delta. Does that make sense?
Yeah, it does.
Okay. So one of the scenarios that I will often run with people is, should I 1031 or should I sell outright, pay cap gains so that I can cost segregate the full value of my new property? Now, I will say more often than not, the numbers say sell the property outright, don't do a 1031, but oftentimes people need to do the 1031 to purchase the larger property. And in the world of residential real estate investment, more doors is king, in my opinion. So if you can go from 5 doors to 10 doors, that's more important, because if you have 2 vacancies with 5 doors versus 10 doors, all of a sudden you've gone from 60% occupancy to 80%. And growing doors. Sorry, go ahead.
Let me walk you back to the thing that you said. It's usually, because this is contrary to like a lot of people's mindset. You're saying tax wise, it's often a better idea to just sell the property outright, take that capital gain hit, versus 1031 exchange. Help me understand why.
That's just how the numbers tend to break down.
Why? What influences it? What numbers influence that?
I mean, the first is what the capital gains hit is, how long they've held the property, what tax bracket they're in, which is why it's critical to have, the financial advisor and the accountant at the table.
Let's say it's 15%.
The other thing is, since we're in this kind of golden age of bonus depreciation, and other than, last year and the beginning of this year when bonus was 60 and 40%, we had at least 80 to 100% dating back to 2017, and now moving forward indefinitely. That 100% bonus bump is really big. And then I will also say that while the residential real estate class will be able to bonus, 15 to 40% of the property, other asset classes perform a lot better when it comes to cost segregation, when it comes to bonus eligible property. For example, car washes. The worst car wash I've ever seen was 60%. And sometimes they can often bonus the entire 100% of the depreciable basis. Gas stations, as long as a gas station produces at least 50% of its revenue from petroleum-based products, gasoline, you can classify the entire depreciable basis into 15-year property without a cost segregation study.
Wow.
I
Somebody had some
mean,
really good lobbyists at one point.
yeah. Now, that said, the higher that number is, obviously, huge tax deferral, but it also kind of pigeonholes you to holding on to it longer,
Yeah.
or into, if you do want to sell it to get into the next property, 1031ing it.
What's it? Okay, let's wrap up with this. What's it? And by the way, fascinating conversation, Brenton. Love this. Thank you so much for joining me today.
Mhm.
What is, give me some dollars here. You do a cost segregation analysis on a single family home. Like part of this is like, well, if it costs me $5,000 to do a cost segregation analysis, man, I really got to weigh the cost of doing the analysis against what I'm going to save here. At what point does it become like not worth it? And what's a market rate for cost segregation? Like what an investor has never done it before. And I know it's going to change depending on how many units and the dollar figure of the but give me some parameters, give me some guidelines.
So the IRS mandates that cost segregation studies are charged based on how complex the property is, not
Okay.
how large the tax deferral that's created is.
Wow, you get regulated by the IRS. You can't
Yeah.
charge more.
No.
This is really fascinating. Why the heck would the IRS care how much you charge for cost segregation analysis?
They're trying to create parameters. Now, that said, not everyone plays by the rules. And the other thing is, so my firm does what's known as engineering-based cost segregation study, which is the highest level of detail. But we also use IRS-approved software, and all of our work is backed with audit protection. Everything is by the book.
Fantastic.
Now, with bonus depreciation and the Big Beautiful Bill and the Tax Cuts and Jobs Act, business is good. So if a firm produces a study that would not necessarily pass audit protection, but said client never gets audited, well, congratulations. You just saved an extra buck.
Sure.
Now, that said, I have some clients that own tens or hundreds of millions of dollars of real estate. And if they earn $5 million in a year and they have a 20% tax bill, you think they're going to look under the hood? Yeah. So
go back to that $500,000 house example. Like if I did a cost segregation study, I did it by the book. I did it for that one property. It's a 20-year-old single family home in Gilbert.
So our firm's fee minimum is $2,800. When you have a basis below like 200, the numbers get a lot tighter. Now, that said,
basis below 200,000.
Yeah. So if you had 20% land value, that would be a purchase price of $250.
Oh, well, you can't hardly find that in the Valley anymore.
No, I know. I'm just for sake of example purposes. Now, that said, a single family home, 3,000 square feet, that's not going to be more than, $3,000. Now, again, we are the gold standard when it comes to detail. There are lower levels of detail or computer programs that can spit one out for $600 or $700. Okay. Now, when you get to more when you get to more complex properties, I know AI technology is advancing very quickly, but at this point, a specifically trained tax engineer that knows how to look at building plans and drawings, improvement detail, etc., is going to be able to produce better results than some computer program. Now, may that change at some point? Yes. But I will also say I've done 80, 90, $100 million, new build apartment complexes, for example, and the cost segregation study was under $20,000. So as the basis increases, the return on your dollar goes up like a hockey stick, exponentially. Yeah. But unfortunately, you can't squeeze, a six-figure salaried tax engineer that's doing your study's time down to, zero. It takes a certain amount of time, no matter the complexity of the property, to segregate it and produce a deliverable.
If someone brought you 50 single-family homes like the one I just described, is the work on your end about the same? So you're still going to be probably around that $2,500 mark per property?
We'd be able to work with that
With
volume. Yeah. If it was a one-off, it's one thing, but yeah, with even
There's economies of
even with
scale.
5 properties.
Yeah.
But I will say that there are a lot of good. I obviously talked about questionable cost segregation firms. There's a lot of really good cost segregation firms out there. Where I differentiate myself is there's very few that also dabble and specialize in the tangible property regulations, which when you own properties for a long time, things, the roof's got to get replaced. You got to replace the carpeting.
I see.
Um,
And that's where you're able to pinpoint like, hey, this, you can actually expense this. Yeah.
Yes, exactly. And when you remove a lot of property, quantifying what needs to be removed from the depreciation schedule, one, to be in compliance, can be very valuable. And then finally, if any of your clients have been like, oh, I wish I would have done cost segregation, but I've already owned this property for 2 or 5 years. Well, one, the property depreciates over 27 and a half. So we haven't used up that much of the original depreciable basis. If you've added things in, like the schedule can keep adding. But one of the cool things is you can switch over. It just requires the change in accounting method form for the IRS form 3115. Not only do we fill that out, but we sign it. Shockingly, most cost segregation firms will fill that out, and then they'll be like, hey, Mark, hand this to your accountant, make him sign it. One, it's not legal to sign an IRS form that you did not fill out, but two, your accountant's butt is now on the line.
Yeah.
So,
Brenton, you've impressed me as definitely an expert in your field. This has been fascinating. You've opened my mind to several ideas. Hopefully some of our clients how do people get in touch with you? Quick, 30 seconds as we wrap up.
I can be reached at Brenton, BRENTEN at tptm.cpa. And I will share a one-pager with Mark that walks through the parts of the tax code that I specialize in, how we bring value to the team. I'm not going to replace your accountant, your financial advisor. I just want to add value to the table. No one's going to lose their job. Hopefully we can just bring the potential of adding these tax incentives to the table. And if they don't work, they don't work. If they do, we can implement them in the best way to fit your tax situation. And any preliminary analysis that we run on properties that your clients own are free. So we can assess the benefit, the tax deferrals or deductions that could be created
before you commit. That's cool.
Yeah.
Brenton, it's been fascinating. I've got to run. Thank you so much. We've got this whole thing recorded. I wanted to ask you about your watch. Are you a runner? Triathlete?
Getting back into it. I'm starting to train for a high rocks race.
Let's go.
Yeah,
I ultra ran for 6 years, so we could swap stories.
Awesome.
All right, brother. It's great talking to you today. Thank you so much.
Well.
And look forward to staying in touch.
Sounds good.